beautiful people. I hope you've been keeping well. And I hope you've been taking charge of your money. We say this year we must win, okay? Come rain, come sunshine. Come at the end of the year when we look back, we're going to be proud of ourselves. So now, okay. So on today's video, I want us to talk about fixed income funds, right? And how they compare to money markets and who they are meant for. Basically, what you need to do to get into them, okay? If this sounds like something that tickles your fancy, then stay with me. Karibu! Okay, so basically, what are fixed income funds and how do they compare to the money market funds? So remember, I always want to paint a picture of the Maslow's hierarchy of needs, like we explained it. At the bottom of the pyramid is your basic needs, right? And we said, for your basic needs, this is where the likes of your money markets and your fixed income funds come through. Why? Because number one, they are very liquid. And two, they give you an above the market interest rate, okay? So now, the difference between a fixed income and a money market, first of all, they're very similar in terms of both of them are like collective investments. So to be honest, most of these things, the difference is where your money is put. Okay? So for example, for money markets, again, I keep reiterating, your money is usually put in treasury bills, short-term corporate bonds, and fixed deposits. But now when it comes to fixed income funds, the bigger chunk of your money is put in bonds. And or rather, if you don't know, the difference between treasury bills and bonds is that bonds tend to be more long-term, okay? So, for example, you hear that the government has floated an 18-year infrastructure bond. What does that tell you? That tells you that this thing will actually mature after 18 years. But that's not to say that you'll not be getting interest between now and at the end of the 18 years. Because how the bonds work, say, for example, you've invested 100K, the bonds usually pay interest semi-annually, okay? So if they say that they are probably paying, 12% interest, that means like when you divide this by 2, it's 6% after every 6 months. So again, for ease of calculation, if you had put in like 100K, that means that every other 6 months you receive 6K, all right? And then at the end of the maturity or at the maturity of that bond, you actually get your initial investment. So now, let's assume, remember for bonds, for most of them, especially in Kenya, the minimum amount that you can invest is 50K. Let's assume you're just starting your investment journey. You actually don't even have 50K to spare. But you have that like 1,000 bob, 2,000 bob. Like you have money that you can spare here and there, but it's not like a lot of money all at once. And you probably just want something that will give you a better return than the money market funds. This is where your fixed income funds come in, okay? Again. So first of all, we've understood the differences between where the money is invested in for both of them. For money markets, they'll mostly focus on treasury bills, okay, and short-term corporate papers and fixed deposits. Fixed deposits is basically when you go and open an account in a bank, for example, and lock in your money for like a period of 1 year, and then you'll take it out after 1 year, okay? And the reason money markets do that is because since they are corporates and since they have a large amount of money, they are able to negotiate for better rates. Now, when it comes to fixed income funds, the better chunk of your money is put in bonds, all right? So what does this tell you? This tells you, unlike treasury bills, or rather unlike money markets, now we've moved from a lower level of risk to a higher level of risk. But always remember, the higher the risk, the higher the return. So for example, like as when I was making this video, if you look at the money markets, they're giving you an average of 11%, but if you look at the fixed income funds, they're giving you an average of between 13 and 14%. So why would I, personal opinion, if I had little money, and again, before I go there, the liquidity is as high as a money market. If you want your funds, you get them between 1 and 3 business days, right? That is like between 24 to 72 hours. So that means that if you need your money, it's also very liquid, okay? Now, here's the catch. Kitambo, these fixed income funds used to have a locking period. Now that does not exist. That is for special units or other special funds that we talked about in our previous video. If you have not watched that, please go back and watch it. All right. So now, This is my question. Why would you want to put your money in a money market if you know a special fund is going to give you, if you know a fixed income fund is going to give you a better return, and also it's going to give you the same level of liquidity as a money market? I'm not saying run away from money market funds. I'm just saying never put your eggs in one basket. Okay? You can, let's say, for example, you have 5K. Even if you have 5K, let no one tell you that your money is kidogo money. Even if you have 5K, you can say, you know what? I'm going to put 1,000 in money market A, 1,000 in money market B, and then I'm going to put 3,000 in fixed income fund A. All right? So now I've told you what they are. You're probably wondering, okay, so now I have this information. So give me examples of these fixed income funds. Imagine that mostly they're the same people who give you the money market funds. For example, we talked about Kuza. Kuza has a money market fund. It has a fixed income fund, and it has a special fund. So you see, they are there for all categories of people. I'm not any of their employees. I'm just telling you the things that I've used and that have worked for me. All right? When you talk of Etika, for example, they have a money market fund. They have a fixed income fund. They have a special fund. I know I didn't talk about them when I was talking about special funds. I just mainly focused on like the ones that are really popular. That doesn't mean that they're the only ones that exist. Because remember, in this channel, we said don't just sit there, do something, do your own research. So here I'm just going to give you pointers. Then you can do your research. Or you can reach to me in my inbox. I usually leave my number down here below. You can send me an email and we can always discuss. All right? Okay, so basically they're the same people. Like I say, for ease, we're living in a digital era. Always try to ensure that whoever you're using, they have an online platform, they have an online presence, so that you're not struggling walking around with papers in this day and age. Okay, look at their fun fact sheets. All right, look at how they've been performing. You can always try. Again, the probability of losing your money, very minimal, not unless there has actually been an instance of fraud. So I want you to tell me down below, between a money market and a fixed income fund, which one would you take? Because the terms are the same. The liquidity is the same. They're the same people who offer it. The only difference is one is low risk, the other one is medium risk. All right? Some of the fixed income funds that I would recommend, like I have said, we have the likes of Etika, we have the likes of Kuza, we have the likes of Avocap, we have the likes of Zimele, we have Nabo Africa. I'm just putting out names over here, all right? But basically, I want to tell you, all this information is available. So feel free. Don't just be lazy. This year, your money has to work for you. Come December, when we look back, I want all of us to smile. Because I believe God is going to keep us to that point. Okay? All right. Until next time, bye. And remember, don't just sit there. Do something.